Hi, everybody. This is Dan Sheridan, and today I'm just going to talk a little bit on, is a long-term iron condor conservative? And today we're looking at an example of a 66-day iron condor. And as you see here, Tuesday, May 16th, early in the morning, nothing, SPX is 41.19 down 17. So if you look here, we're near 41.20. In this example, I sold a 5 delta call, the 44.80, which is about 360 points out of the money. And then for the same delta, 5 delta put, you can get further out of the money. So you look here, we're at, Nova Scotia, Canada here, 34.30. What's that? About 700 points out of the money. And it's the same delta, 5 delta. You say, why is that happening? Because of 5 delta put, a lot higher volatility can get you further out of the money. If you want it more balanced, you'd have to use a higher delta call. But the point here, obviously there's pluses and minuses. Well, the pluses of this trade is, if you're selling 5 delta options, that means it's basically saying there's only a 5% probability we're going to trade above our short call or below our short put in 66 days. Well, that's a plus. So you have the probabilities in your favor. So I guess you could call that, we throw this word, whatever it means, conservative. And that's the big one, right? And that's over 66 days. And you're probably going to be in most of the 66 days if you want your credit. Now, you're talking, if these are 10 wide vertical spreads, you're bringing in 70 cents credit. So your risk is $1,000 per one contract. You're bringing in $70. So your margin or capital you put up is 930. So your most potential yield, it says 7.5% if you make the whole schlemiel, right? And so that's pretty good over 66 days. Okay, those are, I guess you could call, whatever the word, conservative, but you have a lot of room. Now, what's the negative? Well, and the other thing is that's if you make the whole thing. Now, but we're saying, here's the reality. Let's bring reality in for a second. Excuse me for reality. I don't mean to bring in too much reality. But the reality is, on something like this, are you going to win most of the time? Yes, there are probabilities in your favor. But it's all going to, and the other thing, it's very easy on one contract. Well, what if we, talk a little reality for a second and just say, well, if we got 10 of these, all right? Now you got a little more substance. So this would be a $10,000 trade. Difference, these are 10 wide credit spreads. 10 of them, 10,000. You're bringing in 700. So your risk is 9,300. What's not conservative is the risk reward. You could say, is that considered conservative? No, conservative. You're bringing in 700 to risk 9,300. Well, are the probabilities drastically in your favor? Is it normal? This is all normal, right? If you're going to have a high probability trade like this, like you're selling a 5 delta call and put, you're going to have a stinky risk reward. But what makes this conservative or not is really, the fact that all it takes is, probability you're going to win 9 or maybe more, 9 times out of 10. But it comes down to when you have that big move, right? When you have a big move, how are you going to skin the cat? And you say, well, I can roll it out. Well, sure, or I can roll it down or whatever. probably roll it out, but then that yield goes lower, right? Because now you're not making 5 to 7% over 66 days. It might be 5 to 7% over 90 days or wherever you roll it out to. That's one thing. But the other thing is, if you lose, right? I mean, obviously you see on a trade, your risk reward, if you do 10 contracts, your reward is $700. Your risk is $9,300. So all you need is one huge move and you improperly manage it, you could wipe out a year. So really, most of the year, your friends are going to think you're a genius. Or if there's nothing going on in the market, you're a genius. But when you get a move like a COVID correction or the January 2022 where the market goes down a lot, basically when you get a 8-9% move, that's going to show if you have a clue what you're doing, right? You can have the cooks from Chipotle could put on an iron condor, but you can't teach the cooks in an hour. What do you do if this goes against you? So in conclusion, are there some things you would consider about a 66-day iron condor where you're selling a 5 delta call and put conservative? Yeah, there's some things. I mean, you got a lot of time on your hands, be a high expected rate, but to call some, is it totally conservative when if you do 10 contracts, your reward is 700, your potential risk is 9,300, and all it takes is one. You're going to have probably at least one a year where it will test your risk management where you can lose a whole year. So in that regard, with a bad risk reward, it comes down to your risk management, and the jury's out until that happens. Now, I don't have a problem in a portfolio of option trades to, if you want to put something 66 days out, that's fine. But I would definitely combine that with a few trades that are shorter duration to get you more theta. That's the name of the game. So anyways, something to think about. If you have any questions, let me know, or any things you want me to explore, let me know. Thanks again. Dan Sheridan at Sheridan Mentoring. My email is dan@sheridanmentoring.com. Thanks.